Morning, everybody. Welcome to this fourth lecture, I think it is. And in this lecture, we are going to look at financial statements. So at this point, we've done our intro. So we've registered our firm, we've registered it with SARS and all the necessary bodies where it's supposed to be. Then we started writing up all of our transactions into cash books and into general ledgers. And from there, we've done a bank reconciliation to make sure that our business bank account does in fact agree to the bank statement, or if we have any differences, the recon on why those differences are there. So now we're basically sitting with a page full of little ledger accounts. And now we need to try and put that into some format where the reader of the financial statements can very easily get value from and analyze our business and see what's going on. This is not too long of a lecture, so let's start off and go to the PowerPoint. Okay, so on financial statements, from all the little T accounts that I just spoke about, we are going to compile a trial balance. So what is a trial balance? That's simply a list of each of those accounts and whether they have a balance on the debit side or whether they have a balance on the credit side. So we list all of them in no particular order. Most of your accounting programs will list all of your income statement items together and then all of your assets on all of your liabilities. So they'll basically split it between income statement and balance sheet, but this is just an example of what it is. So what we're trying to accomplish here is to see whether all my debits correspond to the credits. So that means that for each transaction that I accounted for in my ledgers, I did write in both legs and I did write them in at the correct value. So we're trying to mitigate the risk of us making mistakes. So on financial statements, we are going to look at two basic ones. The first being your income statement and the second one being your balance sheet. So the income statement is pretty much, the name says it all. It consists of your income and your expenses. So you list your income, your expenses, and that will then basically give you your gross profit for the year. So that will let you know whether you've made money or whether you've lost money from your trading. And the other way to look at the income statement is it gives us a history of how we got to this point. The income statement is historic. It gives us for the last financial year or for the last 6 months. It shows us our trading. So it basically tells us the assets and liabilities that we have today. How did we get to that point? Through generating this amount of income and incurring that amount of expenses, and that gives us our gross profit for the previous year. And then if we look at the balance sheet, the balance sheet is basically or comprises of that formula that we did in the first lecture or in the second lecture, where we said assets equals equity plus liability. So what the balance sheet is it's basically a list of all of our assets, a list of all of our equities, and a list of all of our liabilities. But now we're going to go one step further, where we're going to, within our assets, split between non-current and current assets. So the reason for that is for the banks or the users of the financial statements to be able to better analyze your business. Because if you are a large property holding company, that means, and let's say you bought your property for 30 million rand cash. If we only look at the asset value, your company looks as if it's in a very good position. Now, if you go to the bank and apply for a new loan, then the banks are going to want to see how do you service that loan. Now, if you only have that 30 million rand in cash or the 30 million rand worth of property, you don't have current assets, trading assets to service that bond by. So that's why it's important. We must show what's non-current assets so that the bank can see if things go sour, what can we basically sell but they also need to see current assets, whether there's money moving around, exchanging hands, and whether you'll be able to service that liability. And then under equity, we've got capital and retained earnings. So capital is basically any contributions that you make to the business which you are not planning on withdrawing again and saying the business can keep those monies. And your retained earnings is basically the history of all of your profits and losses from prior years, from day one up to today. What is the total profit and losses that you've made? And then we get to liabilities. And liabilities, we also have to split between non-current and current liabilities so that we can see what we have to pay off over the next 5 years or 10 years. And the current liabilities will basically show us what we have to pay off in the next month or two. So in effect, what the balance sheet is doing is the balance sheet is telling us what will happen in future. For instance, if you've got a debtor as a current asset, that means that in future you will have money coming in from that debtor. And if you've got a creditor under your current liabilities, that means in future you will have to pay money to that creditor. So the income statement basically tells us what happened historically up to today. And the balance sheet tells us, because of that trading, where we stand today, what will happen in the future, what monies will come in and what monies will have to flow out. And ultimately, your net between what comes in and what goes out will then be our equity. Whatever remains is what you as the shareholder can then withdraw and use for yourself. Okay, we lost that last slide there. Let me just start this slide. Okay, so yeah, I've got some basic tests to do to avoid fraud. So this is not for the assignment, but this is just in real life, a few things that you guys have to look out for and keep your hand on your accounting records to make sure that your accountants or your staff members or other people don't steal funds from you. So the first test that you've got to do is to see, does your trust assets agree to your trust liabilities? So at this point, you should be able to call your accountant and say, can you please, as at the 30th of June, extract a list of my trust assets and trust liabilities? And if they're able to do that, then it means you've got a system which is compliant with the act. And if those two agree, then it's great because you don't have a trust shortfall there. Now, some of you guys will think, so what's the bigger problem between the two? So obviously the bigger problem is if your trust liabilities exceed your trust assets, because that means you've got more people or you're holding more funds in trust than what you physically have in the bank. And that means you've got a trust shortfall. So that's the one to watch out for. But then also a lot of people say, no, they want to keep funds in trust. They run a trust surplus. In other words, they have more monies in their trust bank than the clients on their list of trust creditors. Now, sadly, that is also not a good thing. If you fill in your audit report like that, you're not going to get a pat on the back from the LPC and say, well done for building up a surplus in your trust. They are going to investigate why you've got that surplus in trust. So you don't actually want that to happen. So the answer is your trust assets must agree exactly to your trust liabilities. Then step number 2, inspect your bank recon for transactions increasing the cash book balance. So basically what that is, I mentioned that when we were doing bank reconciliations, but what happens is you've actually got a trust shortfall. In other words, your trust liabilities equal or is more than your trust assets. But to cover that, you then capture a fake receipt to the trust assets to lift that to the same value as trust liabilities. But if that money never comes into your bank, then that amount will just stay on your bank recon. So the moment you've got any transactions on your bank recon for more than a day or two, increasing the cash book balance, then that must be a big red flag for you in practice. Then trust creditors with debit closing balances. So when your accountant sends you your list of trust creditors, you must make sure that all of those clients have credit balances. In other words, they have a positive balance in your trust. They've got money in your trust. The moment you have a debit closing balance, then it means you've made a payment on a client's file, but that client did not have enough money in his trust ledger to be able to make that payment. So you've now actually used your other client's funds to settle the shortfall on that specific client with a debit closing balance. So very important not to have debit balances on your trust liabilities. And then what you've also got to watch out for is journals. The moment people start stealing funds from you, then they pass journals. So the reason why journals are so something to watch out for is, for instance, if a client did have a debit closing balance, but you've got another file that does have money on it, then the accountant will do a journal and move monies from the file that does have funds on it onto the file which is now in a shortfall. And that way, when you pull out the list of trust creditors, there's no files with debit balances. So they basically move the funds around with journals. So in practice, you should have a journal book, and every time a journal is passed on the system, that must be written in the journal book, and that must be signed off by yourself. The only time a journal is actually legitimate would be, for instance, if you have a back-to-back conveyancing transaction and the guy needs to move monies from the house that he sold to the file for the house where he's buying. That would be a legitimate journal, and that must then be described like that in that journal book. But you can't just pass debits and credits around between client files to avoid having debit closing balances. Then number 5 is split transactions. So that basically also goes hand in hand with the debit closing balances, because what the accountants can do, if they know you're checking for journals, then they'll run split transactions on the payment. So instead of allocating a payment to a single client file, if they see there's not enough money on that file, they'll then take that payment and split it into numerous payments to numerous files where there are monies on. And then obviously it just keeps rolling. The moment that file then has to pay out, they'll move money from the next file to sort out this file, and from the next to sort out this problem. So split transaction, also something to worry about. Then I've said live customer statements. The number one test to make sure that your clients, or to make sure that there's no fraud in your business, would be to send out live customer statements from your system. Because the moment an accountant passes a journal to a file, or uses someone else's trust funds to cover a shortfall, if that client receives a live customer statement, that journal or debit balance will reflect on their statement, and they will instantly get on the phone and start shouting at you, telling you that they've got more monies in your trust than what your statements are reflecting. And that would then also be a way to get around, well, a way for your customers to do all of your checks for you, and in such a way pick up the messes that your accountant or staff members have made. And then number 7 is supplier reconciliations. This is also an area where there's a lot of fraud. So what the guys will do is they'll specifically load a recipient on your bank, and you'll pay that for a number of times. Then they'll change the banking details to their own and make a payment and attach it to an invoice, a legitimate invoice, show that to you. And obviously you don't check the banking details of each supplier every time that you make a payment. Once you've loaded them, you accept that it's correct. So in that case, they'll pass the transaction and pay it to their personal account. But your supplier will then eventually start hassling you because they never received the funds. So if you do a supplier recon every month, then you'll pick that up you'll pick it up very quickly. The problem is where you don't, and those suppliers also are not that diligent in sending you statements for overdue accounts, then potentially the guys could be doing this on a number of suppliers over a long period of time, and you can then suffer significant losses. So we want to do supplier reconciliations to make sure that all the payments that I make did in fact reach my supplier and that they've debited that against my account. So that is just some basic tests to do to help you guys to avoid fraud. So hopefully you will, on Monday or whenever you watch this, go back to your accountant and do a few of these checks and just make sure that you are in line with all of the rules. So our little teaching example for this morning is going to be to take a trial balance, and we are going to slot this trial balance into a set of financial statements. So on the left here, I've got my balance sheet. Under balance sheet, I've got assets, which I've split into non-current and current assets. I've got equity, I've got liabilities, and I've split my liabilities into non-current and current. Then I've got an income statement. In my income statement, I'm going to load all of my incomes. I'm going to load all of my expenses. And at the end, I'm going to make either a profit or a loss. So now I just want to draw that little template that I gave you guys in the second lecture to say that if a T account or if a ledger account has a debit balance, it's either an asset or a expense. If it's got a balance on the credit side, it's either a liability or it is income. Okay, so now what we're going to do is we're going to assess each of these account types and see where to slot them into our financial statements. Now, this is not important for our LBF assignment. This is, however, important for your business plan, because in your business plan, you have to put a set of your financial statements, your balance sheet and income statement. And this is also very important for real life, because obviously all of your lawsuits and things that you do is about money. So if you can't proper analyze a set of financial statements, you won't be able to tell your client whether it's worthwhile to pursue recovering the funds or get a garnishee order or whatever it might be. So it's important for you guys to be able to read a set of financial statements. Okay, so let's start with the first one. The first line says bank charges, and that has a debit balance of 4,000 Rand. So then what we do is we first go to our little template here and say it's a debit balance. So let's look at those two options there. The first one is an asset. The second one is an expense. So what's the rule with the asset? Asset means that you will in future receive economic benefits. An expense means that you as the shareholder have now lost value and you will not in future get that money back. So what's the case with bank charges? After it goes off with my bank, will the bank give it back to me? Definitely not. The money is gone. So under expenses, I'm going to put bank charges, and that will be worth 1,000 Rand. So at this case, at this point, I've made a loss because I've only incurred expenses. Let's look at the second one. Second one says business bank account, and that's got a credit balance. So that means we have to go and look in the credit column. So my business bank account can have either a debit or a credit balance. What does a credit balance mean? Credit balance means your bank is in overdraft. So you've spent more money than what you've got in. Can you ever have a trust bank account with a credit balance? The answer is no. You can never have paid out more monies in trust than what has come in. But on your business account, that is possible. So let's look at that from the point of a shareholder. Will I, as the shareholder, now in future have to put my money into the business to cover that business bank overdraft? Or will the bank tell me you can just keep the money and we reflect it as income? So the answer is obviously this is a liability, because in future you as the shareholder will have to repay that overdraft. And your bank account we always show as a current liability, because there's monies coming in and out the whole time. It's a trading liability. So I'm going to put a line item in there called bank overdraft in the amount 5023. Then let's look at the next one, shareholders loan. That's also got a credit balance. So that means it's either a liability or income. So at this point, it's called a shareholder's loan. So that means the shareholder has borrowed monies to the business, but he wants that back at some point. Now, in practice, what we do is we show the shareholder's loan, although we'll probably not repay that to the shareholder anytime soon. We want to show that as a current liability so that if things go south, we can repay the shareholder at any point. There's no fixed contract that says it should be over a longer term. So under my current liabilities, I'm going to say shareholder loan, 1,000 Rand. Then let's look at the next one. Cash on hand, and that's got a debit balance of 4063. So that means it's either an asset or an expense. So let's think cash on hand. So that's basically your little box full of 100 Rand notes that you keep at reception. And if you quickly need milk and anything from the shop, you just give your courier $100 and they go. So that physical box full of cash, is that an asset or an expense? So ask yourself, if you are the shareholder and you stop trading in 1 month from now, will that be money in your pocket? And the answer is yes. You can physically go and take all the cash in that box and take it for yourself. So your petty cash box is a current asset because you also use it on a daily basis. You put money in, take money out for whatever reason. Then let's look at the next one. We've got cellphone expense. So this is basically your MTN or Vodacom usage contract. So it's got a debit balance of 3,000 Rand. So we're looking on the debit side there. Is that an asset or is that an expense? Can I in future go and claim my contract amount back from Vodacom? And the answer is no. After I've paid it to them on a monthly basis, that money is lost. That means my cell phone expense is a expense account. Let's just quickly think. If I said the cell phone handset, what would that be? That would be your actual cell phone that you use, your iPhone or Samsung or whatever phone. Would that also be an expense, or will you receive future value? Will you only use your cell phone for the next month, or will you be able to use your cell phone for a period of longer than 12 months? And can you sell your cell phone if you want? And the answer is yes. So if that line read cell phone handset, then it would not be expense. In that case, it would be an asset because we can use it over a number of months. Then we get to the next one, computer equipment. So this is now your physical PC. This is not the guys that maintain your PC and do your backups and all of that. This is when you went to the shop to buy your actual PC. Now that is very much the same as the handset that I just discussed. So if you buy a PC, will you only be able to use it for the next month? And the answer is no. You can write or you can use that PC for a number of months or number of years, and therefore we classify computer equipment as non-current assets. The value of that is 10,000 Rand. Next one, installment sale creditor. So you'll see these two lines go hand in hand with each other. So basically what that means is I purchased a motor vehicle of 30,000 Rand, but I didn't buy it in cash. I financed it through Westbank or MFC or one of those financing houses. So let's first do the easy one. The motor vehicle has a debit balance of 30,000 Rand. So is that an asset or an expense? If I say expense, that means I can only use the motor vehicle for the next month. That's not the case. I can use that motor vehicle for a number of years. So it is an asset. And let's look at the liability side. How long will I pay off this motor vehicle? Now, if I was to pay this full 30,000 off in the next 12 months, then I would have classified that as a current liability. But in this case, I'm going to pay this car off over 4 or 5 years. So my installment sale creditor will be a non-current liability because I'm paying it off over more than 12 months. Then the next one that we've got is printing and stationery. So again, it's on the debit side, so that means it's either an asset or an expense. Now, if I go and buy some paper and pens and all of that, I will most likely use all of that in the next month. I don't really receive long-term value from that. Once I've printed on my papers, there's no value. I can't go and give them back to SPAR and say, thank you, I've now done my printing, you can take it back. So printing and stationery will be an expense. Now we've got professional fees. So this is the fees that you earn for work done. And that has got a credit balance. So that means we're looking at those two line items there. So if a client pays money into my account, will I have to pay it back to them or can I keep it? Now, if it's for fees, that means that I can keep it. So professional fees is a income account. So I'm going to go to my income. I'm going to list it there as professional fees, 50,000 Rand. Then we've got rent expense and rent deposit, which we also did when we did the ledgers. So let's first look at rent expense. That's got a debit balance. In other words, it's either asset or it's an expense. So in this case, my rental, when I pay for my usage of my office, after I've paid that and use the office for the month, will the landlord give it back to me or can I sell it to someone? And the answer is no. So my rent expense is an expense. I'm going to add it in there. 7,000 Rand. And then we get to the rental deposit. So the rental deposit is also a debit account. It's got a debit closing balance. So therefore, it's either asset or an expense. When my lease expires, will the landlord pay my rental deposit back to me? And the answer is yes. So will I receive money from this in future? Yes. So my rental deposit is an asset. And in practice, we show rental or any deposits paid as current assets. Why? Because we can stop that contract at any point and get our deposit back. So we show that as a current asset in practice. Now we've got salaries. Salaries has a debit balance. In other words, it's either asset or expense. After you pay your employees, will they give the money back to you or will they repay it to you in future? Definitely not. So salaries will be an expense. Then we've got business creditor ABC stationers. that has got a credit balance. So that means we are looking at those two options there. It's either a liability or income. So let's ask ourselves, will we in future have to pay out funds because of that stationery supplier? And the answer is yes. That is his account. So in future, we'll have to pay him 3,000 Rand. So under my current liabilities, I'm not going to pay him in 12 months. I'm going to pay him next month. So that's why he's a current liability. And now we've got business debtor client A. And that's got a debit balance. So this is referring to your actual client's business ledger in your set of accounts. So if it's a debit balance, it's either an asset or an expense. Will I in future receive value from this client? Will he pay me? And the answer is yes. That's what he owes me in fees, and he will in future have to pay that to me. So my business debtor is a current asset. Why current? Because hopefully he's not going to pay me in 12 months or more. He will settle his account next month. And then lastly, we've got UIF and PAYE owed to SARS. It's got a credit balance, so it's either a liability or income. So if it's the UIF and the PAYE, I deduct off my employees when I pay them their pay on the 25th, but then I have to pay that money over to SARS by the 7th of the next month. So at the end of this current month, which we are now doing, well, that is a liability. I will have to pay those funds out in future. So it's a current liability because I'll be paying it next month. And that's all of the accounts accounted for in either my income statement or my balance sheet. So let's have a look at this. I've got income that I've generated of 50,000. I've incurred expenses of 37,000, and I've made a profit of 13,000. So from that box of slips where we started, can you see how easily I can now give the user of my financial statements value? Because if they ask, what's my firm's turnover? I can just go there and say it's 50,000. What's your firm's profit? It's 13,000. And then in the balance sheet, I've got my assets, non-current assets, liabilities, non-current liabilities. But here is some problem now. I've got a difference. My equation is not working out. Because if I take my assets and I deduct my equity and liabilities, I've got a difference. Now, what is this difference? Remember, assets equals equity plus liability. So what is equity? If we go back to that original slides of ours, we said equity is the balance of my income and expenses. So under equity, I'm going to have a line that says profit, loss. And where do I get that? What is the balance between my income and expenses? That is my net profit in my income statement. So the moment I add that, my balance sheet and my assets equals my equity plus liabilities, and my balance sheet balances. I've got a zero difference. Okay, so that's all that I wanted to explain to you in this. So again, as I said, not that important for the LBF assignment, however important for business plan and very important for real life. And hopefully you can now start to see how all the accounts slot into the big picture. So every time we did a T account initially and we had to decide whether it's asset or equity or income and expense, when we made that decision, we basically went and we classified it under one of these 5 categories here. Okay, that is that in terms of financial statements. So we'll shortly start with the final lecturing session, which will be cash flow and budget.